As you just heard, I'm Harry Kelly, 2020 scholar from Victoria. Farming beef cattle, sheep, cropping, and my COVID crisis was to go and buy a dairy farm, so I'm living my topic. I had the easiest Nuffield topic of any scholar has ever had. 4 years ago, when I set out to research investment models in agriculture, everything was on the up. I couldn't understand why only a select group of investors were interested in Australian ag. Now I know why, and that easy topic isn't so easy. In 2021, Australia was the 13th largest economy in the world by GDP. 2% of this was attributable to agriculture and an industry that was only employing roughly 2.5% of the working population. So what does this mean? This means we in agriculture are not of high importance politically, and this isn't going to change. Advocacy is hard. I wasn't alive when the floor price scheme for wool was abolished. I wasn't alive when interest rates were over 20%. Fortunately, few of us have experienced severe input shortages, and not for an extended period of time. Agriculture is subject to more variables than any other industry or sector. But I digress. This journey started just over 4 years ago when, standing in a lush paddock with expensive sheep and cattle grazing around us, I naively said to a financial advisor, sharebroker, "How good does agriculture have to get before everyone wants to be a part of the industry and invest?" With the flow-on discussion being about how I, as an owner-operator, can potentially capitalise on outside investment to expand. I've taken a deep dive over this journey trying to answer questions like, why is agriculture different to other investment classes? Who is investing in agriculture? Why are they investing in agriculture? What models and business structures are being utilised? How can businesses expand? Is it debt, leasing, outside equity, or maybe even vendor finance? What are the drivers of success and conversely the prohibitors to success? Are we in Australian agriculture going to simply follow the lead of other countries on their agricultural journeys, reaching the same endpoint? My answer is no. We do not have the same tax system as America, which acts as a massive influence on investments, incentivising city-based ownership of agricultural land with no accompanying suggestion or incentive to operate it, resulting in a high utilisation of lease models. We do not have the geopolitical risk of South American countries where currencies and inflation are spiralling and laws and governments are unstable and unpredictable. We do not have the subsidies of Europe dictating land use and operations, often limiting input use and mandating priorities such as green corridors and conservation. We do not have the trade restrictions and barriers to entry of Russia and Ukraine. No further explanation needed. We do not have the political hurdles to be able to invest like in China and wider Asia. You and I cannot simply roll up and purchase land in China. We do not have the same demographic of consumers to supply our produce to as in Africa. Australian agriculture is unique. What do we have? Relatively high cost of production, relatively low subsidies, relatively low political risk, relatively secure tenure of land, highly variable weather and climatic conditions, and a highly developed supply chain system. This is the rollercoaster of agriculture that we have been dealt over the last 23 years. But appreciate the ride of my Nuffield journey since 2019. I've used the Eastern Young Cattle Indicator as just one example of commodity prices, while using national land and rainfall data, appreciating that volatility will only increase if we were to choose a particular location. I've indexed these 5 drivers, and put simply, the further they get from the trend line, the faster they seem to ultimately return to average. If nothing else, appreciate the volatility and speed at which the landscape of the industry we invest in changes. So what does this really mean for investing in Australian agriculture, and how do we do it well? To answer this, I found we had to define what is an investment in agriculture. Based on the scope of my research, which is primary production, I have defined an agricultural investment as one that is for the purpose of producing food and fibre. However, this needs further clarification. In my view, This needs further clarification. In my view, agricultural investments need to be separated and evaluated in two segments. The first being the acquisition of land, being a real asset seeking to make a return through capital appreciation. The second being the undertaking of an operating entity seeking to generate turnover and a margin retained as profit. Far too regularly, these are not considered independently, but they should be. When grouped together, overall business performance is difficult to evaluate and take effective corrective actions. For example, if a business is too reliant on the investment in land and lacks viability as an operating entity, the business will have a diminished capability to use debt as a tool due to concerns around surrounding loan serviceability. Now, I wish I could sit here and tell you that my findings say, if you nail that, you're home and hosed. But unfortunately, it didn't prove that easy. Furthermore, it's important to understand three more very valuable concepts. Risk-reward profile. What does the return have to be to make a risk worth taking? I will keep referring to this concept, but ultimately, we demand a much greater return from an investment in a tech stock holding no physical assets and may be totally redundant tomorrow. Conversely, we have a much more sedate expectation from a bank bond, and this is because of the risk-reward profile being very different. So where a particular agricultural business lies on a risk-reward profile will dictate its viability and how and when it should be owned. The cyclical yet volatile nature of the industry we operate and invest in, given the variables the industry is exposed to, never do we get 2 years the same. Climate, markets, commodity prices, input prices, cost of finance, consumer sentiment, all dictate that fluctuations occur, and this needs to be expected and makes timing critical for both timing of investments and timing of operations. Using averages rather than a point in time, as I have already highlighted, primary production is highly variable, but history has shown us that we continue time and time again to revert back to the average. Looking at an investment in beef when the Eastern Young Cattle Indicator is 25% above its previous ever record high is not going to be realistic. Sensitising your analysis using a longer-term average is much more appropriate. The commodity prices, input prices and interest rates, etc. are all financial factors that should be taken into consideration as a longer-term average when evaluating an agricultural investment. Now we've looked at what we need to take into account when analysing investments in ag, let's look at who is investing in ag and what strategies they are currently using. Who are the various types of investors and what works for them? I've considered the following groups: foreign investors, pension funds, corporate investors, high wealth individuals, funds, family farms and private investors. I'm not here to say anyone should or shouldn't be allowed to invest. That is one of the positive attributes of our industry. We operate in a relatively free market with minimal interference. What I have done is segregated investors into two groups: owner-operators and the rest, which we'll call corporates. When we contrast owner-operators and corporates, generally speaking, some clear themes emerge relating to growth versus operational returns, decision-making, and the importance of people. Compared with owner-operators, corporate investors are disproportionately realising increases in asset value and growth, and are significantly more mature in their use of data and analysis to make decisions on buying or selling agricultural investments. Using this data, corporates can access broader geographic investment regions and asset classes for comparison and incorporate that into a strategic framework that outlines the opportunity they present to potential and current investors. They have a predetermined target and measures of success, and their governance and accountability frameworks are regularly monitored for compliance and status of investment success. Structurally, corporates have a greater challenge to ensure that all stakeholders, be it investors, board of management, operational support functions and farm level management, are working towards and understand the common objectives. Within the corporate structure, there are a lot of factors that need to be universally understood in order to be successful. Here are a few: growth versus return strategies, high input, high output strategy for production, importance of ethical investments, operational goals, timeframes. This is for investing and for operations. Ultimately, the corporate investor uses their resources, structure, and capabilities to enter and exit investments more frequently and create strong asset growth outcomes. Failure to have unity of purpose and appropriately defined and incentivised decision-making at all levels of business appears to be the most significant reason for operational return failure. Conversely, despite having limited resources for structural support, the owner-operator can be more agile and use real-time data and information to make and act upon localised operational decisions without worrying about overarching leadership structures and financial delegations of authority. The result is that their assets are more stable in market, failing to exploit or realise the capital gains, but they have comparatively stronger operating returns. In a nutshell, owner-operators are often realising comparatively better operating returns, while corporates are capturing capital gain of land, often driven by the improvements to the productive value of that land by owner-operators. Let's take it a step further. Look at tools to enable investment and expansion. Within agriculture, prominent investment models are debt financing, equity financing, lease arrangements for both land and livestock, agistment, co-investment, and vendor financing. These are tools which have a place in the industry, but it is constantly reviewing the business placement on a risk-reward profile and evaluating how this can enhance the triple bottom line, which dictate what the levers are to pull at a given point in time. If we consider measures of success, I'm suggesting that investors in agriculture should have required outcomes that are no different to if there was a similar stock on the share market or residential real estate market. Whilst such a stock doesn't exist, the principles are the same. Just as anyone would do when investing in the share market or buying an investment property, the investor needs to use data to decide on a hurdle rate of return. Should it be 5%, 8%, 10%, or maybe even 12%? And I would suggest this should be a return on equity as well as a return on assets. This rate of return depends on the risk, reliability, and highest and best use, but will also vary over time as the economic environment we operate in changes. This is not a two-dimensional industry. Simply put, diversification in both enterprise, structure, and tools to execute is healthy and manages risk. The required proportions for the recipe is unique for each business. So after all of this, I haven't found a standalone answer to my question, how do we invest well in Australian agriculture? The industry is extremely complex and subject to a huge number of variables, which have different impacts for different types of investors in agriculture. When corporate investors have such a strong tendency for growth and are unable to realise supplementary operating returns, the feast or famine nature of agricultural land prices, commodity prices, and input prices means that corporate and foreign investment cannot be relied upon for the longevity of our industry unless we can incentivise and empower the people at an operating level. So do your research and analyse using averages over an extended period of time. So I pose the question, are we investing in agriculture because of the production of food and fibre, or are we actually just using that as an excuse to invest and hold a unique real asset, farmland? So that comes to the end of my presentation. I'd like to throw out a massive thank you to Rabobank. Their support of my scholarship in particular has been overwhelming, and the support of Nuffield community, to Jodie and the team, and most importantly, the support of my family, Prue, Charlie and Gracie. Thank you, everyone.